Okay, so welcome to the capital budgeting tutorial session. Okay. All right. So in our discussion, we have four ways of testing the feasibility of capital budgeting. So we have the first one here, accounting rate of return. So this method is uh, getting the average of the accounting profit, okay, and then that will be divided by the investment uh, put up in the project, okay, of course multiply by 100% to get the rate of return. So the rate of return, accounting rate of return in this case should be greater than the cost of capital used uh, for putting up the project. Okay. In payback period, the method of payback period is to determine how many years or periods it will take to recover the cost. Of course, if the project is estimated to last for, let us say, 10 years, the payback period should be shorter than 10 years. Okay. So by doing that, you'll get the cash inflows from the projects, okay, and then use that in determining how much had been recovered over the cost. Now, net present value is quite different because this particular method had considered the time value of money, okay, wherein in the two previous methods they ignored. So time value of money is important because the money that you had borrowed may have some discount rates, okay? And also it considers the timing of that cash flow, so you cannot just get average of the profit and then take or determine the percentage of return. In this case, it will consider the uh, how much is the present value of the cash per period, and then that it will try to compare those accumulated net present value, present value of cash flow against the investment. Now, net present value, if it is positive, that is a good sign, meaning you recovered your cost, okay, while considering the effect of the timing of cash flow. If it is negative, of course, the investment should not be continued. The internal rate of return is quite similar with the accounting rate of return, but in this case, you are considering the time value of money, okay, in determining the rate. So whatever you calculated here, okay, should be greater than the cost of capital. Okay, if it is not, then it means that you are not supposed to continue the project. Okay. So let's have an example of how to solve this. Okay. The directors of Milo Limited are currently considering two mutually exclusive investment projects. Both projects are concerned with the purchase of a new plant. The following data are available for each project. So in project 1, we have cost of investment 100 million pounds, 100,000 pounds, and then project 2, 60,000 pounds. And then the expected annual operating profit or loss, we have in year 1, 29,000 for project 1, while in year 2 it will be negative or loss of $1,000 pounds, and then in year 3 2,000 pound as pounds as profit, while in project 2 you have on year 1 18,000 pounds, then a loss of 2,000 pounds in second year, and third year we have a profit of 4,000 pounds. The project at the end of the life of the plant, for project 1 that will be 7,000 kina, while project 2 will be 6,000 kina. The cost of capital mentioned here is 10%, okay? And then they use straight line method for all non-current fixed assets and when calculating for operating profit. Neither project would increase the working capital of the business, so which means it's a separate venture. The business has sufficient funds to meet all investment expenditure requirements. So we are asked to calculate for the net present value, the approximate internal rate of return, and the payback period. And of course, state why the reasons with the reasons which, if any, of the two investments projects the directors of Milo Limited should accept. So let's try project 1. In project 1, the annual depreciation of the plant or the project will be 31,000 pounds. Remember that salvage value or the residual value should be deducted on cost to get the depreciable cost. And the depreciable cost, we are using straight line method, so you just have to divide it by 3. So same thing with project 2, you have 60,000 less 6,000, the difference. You have to divide it by 3, you have 18,000 pounds per year. It's important for us to calculate this because we need to determine the cash flow. As we know, accounting profit consider non-cash expenses. So we need to sort of cancel out, okay, those non-cash expenses. So let's see in the first solution here, okay. For project 1, we determine that the cash flow will be like this. We have the profit, add back the non-cash expenses, which is the depreciation. You have profit before non-cash expenses, which is the cash flow, 60,000 pounds. Then profit, you have 1,000 pounds loss. Then you have non-cash expense depreciation 31. So profit before non-cash expenses is 30. And for the year 3, you have 2,000 pounds and then 31,000 pounds as non-cash expense. So you have 33,000 for non-cash expense. Let's try to solve first for net present value. Now the net present value, the year 0, that is the initial year, okay, 100,000 pounds. So of course the present value of that one, that is initial, so that is 1. You can see the 10% discount factor down there. You have to use the present value table, okay, provided in text, or you can use the formula, okay. So in year 1, you can see there 29,000 add 31,000, 60,000. Year 2, $1 loss, 31,000 non-cash expense, we have 30, and year 3, 33. Now you can see that the residual value is 7. It means that at the end of the period, we are expecting to sell the plant or the project, or we are expected to receive sort of compensation over the project. So the cash flow will be year 0, that is 100, year 1, that is 60, okay, year 2, that will be 30, and then year 3, 40. You multiply it by the present value factor, okay. You can see in the table, or you can use a formula. So $60,000, you have 54,540 for present value, okay. So 60 multiplied by 0.909, you have 54,540. Same thing, 30,000 multiplied by present value factor 10%, you have 0.826, so you have 24,780. And for year 3, you have 40,000 multiplied by 10% present value factor 0.751, so you have 30,040 pounds. Alright, so in terms of internal rate of return, you can see that I highlighted 15% there, okay. Now we just speculated it. We really don't know what is the percentage, so we just assume that will be 15%, okay. So as you can see on the previous slide, the net present value is positive, so most likely it's more than 10%. So let's try. When you did that, okay, you have cash flow of 100, okay, that will be for investment, and 60 for inflow, 30, 40 for years 1, 2, and 3. You multiply it by 15% discount factor, you have this. Okay, inflow will be 52,200 pounds for first year, second year is 22,680 pounds, and then 26,332 pounds on the third year. So net present value 100,000, okay, for 100,000 in this case, okay, less the sum of all those inflow, okay, for years 1, 2, and 3. The amount is excess of £1, and 20 p's, okay, pennies. Okay, so in this case, you can see it will be around 15%, between 15% or around 16%. Okay, so we can only estimate on that. Now for the payback period, you just have to consider the net cash flow. Okay, in year 0 we have 100,000, year 1 60, 60,000, year 2 30,000, and then year 3 40,000. So the cumulative cash flow there, you can see year 0 is 100, year 1 is 60. You can see the remarks there, the difference between the initial investment less the inflow, first year's inflow, and then year 2 you have 30,000. You can see the calculation there, negative 30. So it's from the 60,000 previously, okay, less 30, right? And then year 3, right? So you have 40, and then cumulative cash 10. It became positive because it exceeded, okay, the investment. It already recovered on year 3. Okay, so you can see in calculation here, 30 over 40, which means the 30 can be reached within 9 months on the third year. Okay, so the payback period will be, of course, 2 years plus 9 months. Now in project 2, same thing. We already determined the depreciation, so you had to add back. Okay, we have year 1 profit before non-cash expenses 36, year 2 16, and then year 3 22. Now using the 10% discount factor that we use in project 1, okay, that will still be the same process. So 60,000 multiplied by one factor, okay, that's 60. And then year 1 we have 36 multiplied by 10% discount factor at year 1, you have 32,720 pounds. Year 2, that will be the same, using 16,000 multiplied by that 10% discount factor for the second year. And for third year, that will be multiplied also. So you can see here, present value, that will be positive. Okay, so net present value of inflow 32,720, 13,220, and 21,030. You add these three and compare it with investment, so the answer will be positive. Then it means that the project will be fine. Internal rate of return for project 2, we'll use this 15%, same procedure. Okay, we have 60, okay, then multiplied by 15% discount factor for all the inflows. Okay, we have a positive 1.84 there. So the IR will be around 15% or probably more than 17%. Okay. Payback period, okay, same process. We have 60 initially, and then you deducted that 24, okay, for the first year, and then and then afterwards you have 8, okay, negative 8. Then on year 3, you already recovered, okay? So 2 years already recovered plus a remainder, okay? So we calculated that one, 8 divide 28, okay? Because 28 is the last cash flow. So it will be around 3.43 months. So it means that the payback period will be 2 years and 3.43 months, or 3 months, okay? 3.5 months.
With all the calculations that we have made, we will compare two projects. As you can see here, I provided the comparison of project 1 and 2. We have project 1, net present value, internal rate of return, and payback period, as well as for those, sorry, the other project, project 2. Okay, let's compare net present value. As you can see, project 1 will provide the higher cash inflow than project 2, but it should not only be the one to use for comparison and determining which project will be a good choice for a manager, okay, or for the investor. We look into the internal rate of return. Now, project 2 provides a higher internal rate of return, so which means with the capital invested, okay, even if it is small amount for project 2, if you compare it with project 1, higher return, of course, is better for the investor. And then if you look into the payback period, okay, in payback period, project 2 recovered faster than project 1. So which means if you will choose between these two projects, the favor will be on project two's side. Okay. You recover faster and you have a greater rate of return. Although in terms of inflow, of course, project 1 will be higher. But then again, because most likely because you invested more money there, there's a possibility that you will generate a higher cash flow, but it doesn't mean that it commensurate with the or it will provide you with a higher return. Okay, it still depends on the performance, as you can see in project 2. So by comparison, project 2 will be the one most likely to be chosen, okay, by the investor or the manager. And that's it. Thank you for listening. I hope you learned something.